I don't think 2026 is going to be a great year for investing in Bitcoin, but 2027 may well be another great year. I just don't buy into this argument that the Great Debasement trade started last year. It didn't. China's already facing the challenge and it has to dig itself out. And the only way history shows that you can do that is to devalue your debt. You can't default debt. Crypto is the most sensitive asset out there on the planet by far. It may well be that the low point of the cycle, the Fed cycle, is somewhere around about early 2027, maybe around the turn of the year.
As Bitcoiners, we've been thinking about debasement for over a decade, right? We're thinking the value of our dollar is being inflated away. We need to protect ourselves, so we go into Bitcoin. And last year, 2025, was the year of the debasement trade. Well, you say the debasement trade hasn't even gotten started. They haven't done the big print yet. Just wait until you see what they're about to do. Is that your thesis?
Yeah, exactly. And I think that, I just don't buy into this argument that the Great Debasement trade started last year. It didn't. And there's a chart that I've just put up, which is looking at the movement of gold in US dollars, okay, which, it was not a 2025 event. The gold price started to move very strongly in mid-2022. And what I've put on the same chart is a black line, which shows People's Bank of China liquidity injections. And this is, if you like, the QE policy of the Chinese central bank. Now, those two lines on the chart seem to correlate remarkably well. And there was actually a Substack I wrote up a few weeks ago, which said, actually, if you look at it in terms of percentage changes, the relationship is even more compelling than this. So you can see a very direct causation from what the People's Bank of China does and the price of gold. Now, let's explore that thought and sort of run through with it. My general thesis is that we are going to get a great debasement. So I'm not arguing against myself on that regard. What I'm saying is it hasn't really happened yet, because what we're talking about is effectively debasing money in the West, because future debts and future debts to GDP just grow exponentially. So they're going to have to dig themselves out of this hole somehow. But it's kind of in many ways a future hole, not a current hole. I mean, clearly, maybe it's a small hole that's getting bigger, and is a better way to look at it. But it's getting a lot bigger. China's hole's already enormous because China's got this huge, huge debt burden. So China's already facing the challenge and it has to dig itself out. And the only way history shows that you can do that is to devalue your debt. You can't default debt for the simple reason that your whole credit system is based on debt. Okay. So you've got to devalue it. In other words, you've got to get the domestic level of prices and wages up relative to your debts. And China's got a huge amount of them, as we know. And that's clearly burdening the economy. That burden or that debt pile is burdening the economy right now. So what China is doing is trying to devalue the yuan internally. Now, I stress the word internally because they've got an external exchange rate and they've got an internal exchange rate. The external exchange rate and the internal exchange rate are separated by capital controls, by compliant state banks, and by huge foreign exchange reserves. So they can maintain a yuan or renminbi dollar cross through these mechanisms, but at the same time devaluing internally. And the only vent for that money is really into the gold market. Crypto is banned in China. They've doubled down on that. They've actually tried to stop very recently any exit of trust money into Hong Kong or other jurisdictions by tax penalties. And they've effectively doubled down as well on capital controls in general. So what they're trying to do, in my view, is to print money internally. And as they print money internally, the Chinese retail investor will buy gold. That's what's driving the price at the moment. It's not Western investors. It's the Shanghai Gold Exchange, which is really the marginal pricer. They've outshone. I mean, the volumes are not the same as COMEX or London. They're still behind. But in terms of activity and marginal pricing, they're much more important. And what you can see here is that the gyrations tend to go together. Now, my view is that what you're seeing, and I've just put up this chart of the yuan gold price, is that if you want to understand this monetary debasement that's starting in China or being led by China here, what we've got to think about seriously is what is the underlying trend in that debasement, because that's going to have a knock-on effect for gold globally. And in my view, gold is moving up with a trend line that I've indicated. And that trend line on the chart saw the gold price in yuan basically bottom exactly at the point it should have done, which was 27,000 yuan per ounce of gold. And what's happened since then is it's bounced through 30,000. So you've had that very clear test of trend, and it seems as if what you're getting is a stronger gold market. Now, China, it seems very difficult to see, obviously, exactly what China is doing. But from what we can tell, looking at the data daily, China continues to print money. And I think you've got to separate the dynamics of the gold price, which is being driven by the Chinese central bank and the need for debt or to devalue debt in China, from what's happening in crypto, which is much more dependent on the Federal Reserve and global liquidity, where I think there's more of a problem near term, simply because the world real economy is got a big appetite for liquidity, and maybe the Federal Reserve is not printing it fast enough, but let's see on that one. But as I said, it looks as if what Kevin Walsh is doing is trying to give the markets what necessary liquidity, what liquidity they think is necessary.
And just over the weekend, you put out a piece because first you look at, of course, Chinese liquidity matters more for gold, but then you say Fed liquidity matters more for Bitcoin. But then this piece this weekend is about untrusted money versus total global liquidity mattering more for Bitcoin. So explain that, and what was the outcome of your paper?
Yeah, that was that was an interesting exercise. That was basically this is one of the charts that we put up, which is looking at the overall movement of crypto and global liquidity. And one of our readers said, "Does it make any difference if those countries that are big Bitcoin users expand their liquidity faster or not?" And I thought that actually that's an interesting thought, because it's one that's worth exploring with data. So basically what we did is we gathered as much data as we could, showing Bitcoin usage by country. In other words, what percentage of the population were using Bitcoin country by country, where, this data is maybe questionable in many cases, but it gives a broad indication of Bitcoin penetration. And we use the inference to say that if there's a big Bitcoin take up, is it that residents in that country, investors in that country, distrust the local money? And that would be probably a fairly plausible inference to make. So what we did is we correlated Bitcoin usage with liquidity by country and created a new aggregate, which was, if you like, a global index of trusted and untrusted money. So in other words, where you've got high Bitcoin penetration, that gives you the untrusted liquidity aggregate. And then if you've got the difference, if you like, with global liquidities and the trusted bit, and we looked at which was the most important driver of Bitcoin. Now, the interesting, the conclusion was, interesting, but maybe I'm not going to say a non-event, but it was it didn't really necessarily show what you'd expect. Put it that way. What it showed was that, or maybe to step back, what we argued right in the front was to say that you've got two drivers of Bitcoin or cryptocurrencies. One is, if you like, the intensive margin. It's, in other words, individuals saying, well, I want more or less Bitcoin for this stage of the cycle, or because I fear inflation right now. So they've got a portfolio and they're changing their allocation. And then you've got the other, which is what you would call the extensive margin, which is basically people saying, well, okay, maybe Bitcoin is a good idea after all. I've never had it before, and I'm going to start using it. And so you've got the penetration effect of new users, which is a little bit like saying, the S-shaped growth curve of mobile phone users, or the S-shaped growth curve of the internet, or whatever it may be, or washing machines or telephones or whatever. And basically every technology goes through an S-shaped growth curve where the take-up's very slow at the beginning, and then it starts to grow exponentially and then it tails off. And so you've got these two effects. And the conclusions we came to is that the strongest and most consistent impact on Bitcoin and crypto, in fact, it was specifically Bitcoin, I should say, on Bitcoin, was the trusted money bit. So if trusted money moves, you tend to get a very strong and consistent correlation with Bitcoin, but it didn't have such a strong multiplier as the untrusted money. And what it seemed to be is that the untrusted money has surges, unpredictable surges, and that tends to have a big effect on Bitcoin. But the consistent driver is, if you like, the trusted money bid, which we think is picking up that S-shaped growth curve, whereas the other is picking up the intensive margin. And that's a mouthful of thoughts, but that's pretty much what we were saying. Maybe it sounds a bit confusing, but broadly, bottom line was that just look at global liquidity. That's probably good enough.
That's probably good enough. So then let's look at Bitcoin in terms of global liquidity. You made it very clear that global liquidity in terms of rate of change bottomed back in 2022 and then peaked at late 25. And that's perfectly in line with the Bitcoin cycle. Now we see that rate of change slowing. When does it finally turn back around, and will Bitcoin be the first to sense it?
Very good point. I mean, I think the answer to the first question is that it looks as if you extrapolate the cycle that I've just shown you, the sine wave that you can see there, the dotted red line, is a 65-month cycle, and we established that about 20 years ago using Fourier analysis on the data, and that's been a robust indicator thereafter. And it would seem as if the cycle is likely to bottom sometime around about the middle of 2027. Now, that seems quite a long way away. I did a more recent exercise. So I said, well, if you just looked at what the Federal Reserve is doing and you basically try to frame Federal Reserve policy, can you get a slightly different answer? And the answer that came back was that if you were just looking at the Federal Reserve, it may well be that the low point of the cycle, the Fed cycle, is somewhere around about early 2027, maybe around the turn of the year. Now that may be pushing it a bit, but that's what the cycle data said. So the bottom line is it could come earlier, and maybe if Kevin Warsh and Scott Bessent are changing the rules here, maybe we ought to start thinking about that. But the markets never lie, so we've got to start thinking about getting into a position where we can understand Bitcoin movements and maybe put it in this context of changes in monetary conditions. And my view through this year has been, and I still hold to that I don't think 2026 is going to be a great year for investing in Bitcoin, but 2027 may well be another great year. And I think that's why we've got to start thinking about this, looking ahead. So that would be my take. So I think that's the key thing. And, your second question, is Bitcoin going to be the most sensitive barometer? I think yes, because we've always said that if you look at the multiplier effects, whether you look at Bitcoin, Ethereum, you look at the S&P, you look at gold, look at tech stocks. Crypto is the most sensitive asset out there on the planet by far, and it's very, very sensitive to changes in liquidity. Therefore, yes, it will move first.
Imagine waking up, opening your phone, and stacking free Bitcoin in under 30 seconds. That's Sats Drop from Rhino. Log in and you get 3 free drops every single day. The chip falls and pays out real Bitcoin straight into your Rhino wallet. No purchase necessary, no catch, just Bitcoin. A single drop can pay up to 10,000 sats in Bitcoin, and you get 3 of them today, tomorrow, and the day after that. Instead of doom scrolling X, stack free Bitcoin in less time than it takes to dunk on Peter Schiff. The only way to lose is by not playing. Click the link below to sign up for free and drop your first chip today. Use code Bitcoin News when you sign up for Rhino to claim your sats and grab an extra $21 in Bitcoin when you deposit your first $100 USD. Sats Drop. Free Bitcoin is just 1 drop away.